You need to be right more than half the time to make money. This is the first myth every new trader absorbs, and it is completely wrong. Some of the most profitable trading strategies in history have a win rate below 40%. Trend-following funds like Man, AHL, and Winton Group historically win only 35 to 45% of their trades, but their average win is several times larger than their average loss. The math is simple. If you win 30% of the time, but your average win is $3,000, and your average loss is $1,000, you make money. Win rate is meaningless without context. What matters is expectancy, the average profit per trade when you combine win rate and win-loss ratio. A 2019 study by AQA Capital Management showed that systematic trend-following strategies generated positive returns across 100 years of data, despite winning less than half of all trades. The myth persists because human psychology confuses being right with being profitable. A 90% win rate makes you feel good. But if your 10% of losses is 10 times larger than your wins, that 90% win rate destroys your account faster than 30% would with proper risk management. Traders who blow up don't get it wrong too often. They get it wrong too big. Buying the dip always works. The idea is simple. When stocks go down, buy them. They'll come back up. They always come back up. And for large cap American stocks over the last 40 years, that has been more or less true. But buying the dip, meaning buy as low as possible, used as a strategy without thinking it through, has destroyed more accounts than any other piece of wisdom in retail trading. During Japan's lost decade, the Nikkei 225 peaked at 38,957 in December 1989. Every dip buyer over the following 20 years lost money. The index did not return to its 1989 high until February 2024, 34 years later. The Nasdaq peaked at 5,048 in March 2000 during the dot-com bubble. Dip buyers who entered at 4,000, 3,000, or even 2,000 watched the index fall to 1,114 by October 2002, a 78% drop from the peak. It did not reclaim the 5,000 level until 2015. Individual stocks are even worse. Traders who bought the dip on Enron, WorldCom, Lehman Brothers, and FTX bought all the way down to zero. Buying the dip works in a secular bull market. It is catastrophic in a bear market, a structural decline, or a fraud. The strategy assumes mean reversion, that prices return to prior levels, without ever asking whether those prior levels were justified in the first place. A dip is not always an opportunity. Sometimes it is the beginning of a repricing that still has a long way to go. Diamond hands is a strategy. The meme stock era turned diamond hands, holding positions through any drawdown and never selling, into a badge of honor. Selling is the weakness of paper hands. Holding, on the other hand, means strength, conviction, and solidarity. But conviction is not a trading strategy, and holding a losing position because the internet told you to is the opposite of risk management. GameStop fell from $483 to $40 in 3 weeks after its January 2021 peak. AMC dropped from $72 to under $5 by 22,000. Bed Bath & Beyond went to zero. Traders who held through these declines did not demonstrate strength. They demonstrated the disposition effect, a well-documented behavioral bias where traders hold losing positions too long because realizing a loss feels psychologically worse than continuing to sit on an unrealized one. Prospect theory, developed by Kahneman and Tversky, explains why losses hurt roughly twice as much as equivalent gains feel good. Diamond hands rebrands a psychological weakness as a virtue. The professional version of this behavior has a different name: blowing up. Every rogue trader who destroyed their institution did so because they refused to take a loss. Nick Leeson did it. Jerome Kerviel doubled down. Brian Hunter, at Amaranth, kept adding to losing natural gas positions. Diamond hands is the retail version of the same psychology that has been destroying trading accounts since markets were invented. Technical analysis is a proven system. Moving averages, Bollinger Bands, RSI, MACD, Fibonacci retracements. Technical analysis has a massive following, but its evidence base is remarkably thin. A 2004 meta-analysis by Park and Irwin reviewed 95 academic studies on technical analysis and found mixed results. Some studies showed profitability, but the findings were sensitive to time periods, transaction costs, and data mining bias. Most patterns that showed statistical significance during the study period disappeared after publication. The explanation is reflexivity. When enough traders act on a pattern, the pattern changes. A head and shoulders formation that reliably predicted reversals in 1990 does not work the same way in 2000, because millions of traders now recognize it and act on it simultaneously, altering the supply and demand dynamics that made it work in the first place. This does not mean charts are useless. Price and volume data contain real information about recent trading activity, but treating chart patterns as predictive systems, meaning this formation tells us this stock will do X or Y, is a category error. The pattern describes what happened. It does not dictate what happens next. Traders who blow up on technical analysis are not the ones using it as a tool. They are the ones using it as a religion, stacking indicator on top of indicator, backtesting until the curve fits, then deploying real money into a system that worked in the past because it was designed to work in the past. Leverage is the way to grow a small account. Every retail broker offers margin. Forex offers up to 500 to 1 through offshore brokers. The pitch is always the same. You don't need a big account. You just need leverage. But leverage does not change your edge. If your strategy has a negative expected value, leverage makes you lose faster. And if you have a positive expected value, leverage increases the probability of ruin before that edge ever gets the chance to materialize. The Kelly criterion, the optimal position sizing formula developed by John Kelly at Bell Labs in 1956, demonstrates that betting beyond your edge leads to guaranteed ruin over time, regardless of the strategy's expected value. Academic research by Zimba and others showed that betting even 50% above the optimal Kelly size reduces long-term wealth to zero, with a probability approaching certainty. The 2015 Swiss franc event wiped out retail Forex accounts globally because traders using 50 to 1 or 100 to 1 leverage were obliterated by a 30% currency move, a move that would have been a manageable loss at 2 to 1 leverage. ESMA, the European markets regulator, capped retail Forex leverage at 30 to 1 in 2018, specifically because the data showed that higher leverage was strongly correlated with retail account destruction. Leverage does not grow small accounts. It accelerates the natural variance of trading to the point where a single adverse move can wipe out months or years of accumulated gains. The market is rigged against retail traders. This myth has two problems. It is partially true, and it is entirely counterproductive. Yes, institutional participants have structural advantages: faster execution, lower costs, better data, more capital, and access to opportunities retail traders simply cannot reach. Payment for order flow routes your orders to wholesalers who profit from filling them. High-frequency traders exploit speed advantages measured in microseconds. Dark pools hide 40% of trading volume from public view. But rigged implies the outcome is predetermined, that retail traders cannot win because the game is designed for them to lose. That is not true. The S&P 500 has returned roughly 10% per year over the last century. A retail investor who buys a broad index fund and holds it captures the full market return minus minimal fees. The market is not rigged against that strategy. It is explicitly built for it. The rigged narrative becomes dangerous when it is used to justify high-risk behavior. If the system is rigged, then investing responsibly feels pointless, and gambling on meme stocks and options feels like legitimate rebellion. Traders who lose money are not losing because the market is rigged. They lose because they trade too often, with too much leverage, paying too much in spreads. In a game where the long-term expected return from passive investing is consistently positive, the market is not rigged. It is simply expensive to participate in frequently. And most active participants underperform because their costs exceed whatever edge they have, assuming they have one at all. You don't need a stop loss if you know what you're doing. This is the lie traders tell themselves to justify staying in a trade that has gone against them. They move the stop, widen it, and eventually remove it altogether. They convince themselves the market will come back, that their analysis is correct, and that patience is all that's needed. But professionals do exactly the opposite. Professionals use stops not because they are afraid, but because they have a plan. Before entering any trade, a professional trader defines three things: entry point, target, and the level at which the thesis is invalidated. The stop loss is that level. It is not an admission of defeat. It is the line that separates a planned trade from an emotional bet. When price hits your stop, it does not mean the market outsmarted you. It means the scenario your trade was built on did not play out. And staying in at that point is not conviction. It is hope. Every single blow-up in professional trading history began with someone removing their stop. Nick Leeson had no stop. Jerome Kerviel kept moving his exit point. Brian Hunter at Amaranth added to losing natural gas positions instead of respecting his risk limits. The psychology is always the same. The trader decides the market is wrong, and they are right, and refuses to accept the invalidation level they defined before entering. The disposition effect, documented by Kahneman and Tversky, explains why realizing a loss is psychologically twice as painful as the pleasure of an equivalent gain. So the brain invents reasons not to exit. Retail traders fall into this trap because they treat the stop loss as an enemy, something that takes their money away. Professionals treat it as the only thing that keeps the trade within the boundaries of the plan. Without a stop, the trade has no structure, no defined risk, and no point at which the thesis is wrong. A trade with no invalidation point is not a trade. It is an open position based on hope that the market does what you want. A stop loss does not protect you from being wrong. It protects you from staying in a trade that is no longer the trade you planned. That is the difference between taking a controlled 1% loss and finding yourself in a 30% drawdown because it was supposed to come back. Professionals do not survive because they are right more often. They survive because when they are wrong, they exit at the level they defined before emotions entered the picture. A stop loss is not weakness. It is discipline. And in trading, discipline is the only thing that separates those who stay in the game from those who get wiped out. On that note, don't risk your own capital. I'm leaving links in the description to some prop firms, meaning companies that provide you with capital to trade. You keep the profits while losses are covered by the firm. In 2026, there is no reason to put your own money on the line. I'm also including special discount codes that let you access these accounts for very little. We're talking a few dozen dollars to get up to $2,000, $3,000, or $6,000 in drawdown. All the details are in the description. You need to watch the market all day. This is the myth of the trader, glued to the screen, locked onto candlestick charts, monitoring every single tick and reacting to every move. The myth persists, despite evidence showing that the more time you spend in front of the screen, the more it correlates with worse performance. A 2000 study by Barber and Odeon, published in the Journal of Finance, found that the most active traders, those who traded most frequently, achieved lower net returns. Their gross returns were roughly average, but transaction costs ate into everything. More recent data from FINRA confirms the same pattern. Trading frequency is inversely correlated with account performance for the vast majority of retail traders. The reason is behavioral. Watching the market in real time triggers emotional responses. Anxiety during drawdowns, euphoria during rallies that produce impulsive decisions. Every tick feels like a signal. Every red candle feels like a reason to act. The result is overtrading, premature exits from winning positions, and delayed exits from losing ones. Warren Buffett famously said that the stock market is a mechanism for transferring money from the impatient to the patient. The myth that you need to watch the market all day is the engine of that transfer. It manufactures the impatience that drives unprofitable behavior. The most consistent returns in financial market history have come from investors who checked their portfolios rarely and traded infrequently. For most traders, doing less is the single most profitable change they could make. Past performance predicts future results. Every investment disclaimer states that past performance is not indicative of future results. Every retail trader ignores it anyway. They look at a stock chart, see a trend, and assume it will continue. They find a strategy that showed profitability in a 10-year backtest and assume it will work going forward. They see a fund manager's 3-year track record and assume the returns will persist. The academic evidence, however, is overwhelming. Past performance is one of the weakest predictors of future returns across virtually every asset class and strategy. A 2010 study by Fama and French found that mutual fund performance showed almost no persistence. A fund in the top quartile one year had roughly equal odds of landing in any quartile the following year. The S&P Dow Jones Persistence Scorecard consistently shows that fewer than 3% of top-performing funds maintain their ranking over any 5-year period. The reason is structural. Market conditions change, strategies become crowded, edges get arbitraged away. The backtest showing 200% annual returns worked under a specific market regime, low volatility, trending, or mean reverting. When the regime shifts, the strategy fails. Traders who chase past performance are not stupid. They are human. The brain is a pattern recognition machine that assumes patterns will continue until proven otherwise. In markets, that proof usually arrives in the form of a destroyed account. One big win will change everything. The fantasy of the life-changing trade, the YOLO, you only live once. That turns $5,000 into $500,000. The options play that goes up 100 times, this is the most seductive and destructive myth in retail trading. The lottery mentality applied to financial markets. And yes, it does happen. DFEs trade on GameStop, the early Bitcoin buyers, the traders who caught the COVID recovery in 2020 at the bottom. These stories are real, but they are survivorship bias in its purest form. For every trader who made 100 times their money, thousands made the same bet and lost everything. The options market makes this visible. The OCC reports that 23% of all options expire completely worthless. For weekly out-of-the-money options, the instrument of choice for YOLO traders, the percentage is dramatically higher. The pursuit of a big win produces a specific behavioral pattern. Small gains are taken quickly, but they never feel like enough. Small losses are held or doubled down on because the big win is still coming. Risk per trade escalates over time as the trader chases increasingly improbable outcomes. This is the classic profile of a problem gambler, not a profitable trader. Consistent profitability in trading comes from a repeatable edge applied with disciplined position sizing. Hundreds of small wins compounding over time. It is boring, it is slow, and it is the only approach that survives contact with real markets over a meaningful time horizon. A big win is not a strategy. It is a prayer, and markets do not answer prayers.